So while managing this fund over the last 16 years, it has been a great experience meeting top management. And during this period, what I have learned is that you have to bet on the right management, because that is what makes a difference to the company over market cycles. Management which has a vision to really look beyond the current and look into the future, which is able to adapt to the circumstances around that and is able to innovate. I think such companies have been able to really do well across business cycles and do well over a long period of time. So endeavor has to be identify such companies. Also, when we look at businesses, we are looking at companies which have some kind of a key competitive advantage, okay, or a moat, which gives him the companies a particular advantage in terms of margins into the distribution, which will lead to sustainable earnings over the longer term. And over a period of time, we've seen that the focus should not be more on profit, but also in cash flow generation. What are the cash flows the company is able to generate, and more so the free cash flows after capital expenditure, because that is what creates wealth over the longer term. So companies which have delivered that, I think, have done fairly well. And normally we look at businesses which are growing faster than the GDP or growing faster than its category and gaining market share. So that is been kind of a philosophy, okay, which we have adopted to look at businesses which are growing slightly faster than the market. And other learning, I think, in terms of the portfolio construction and management, I would say is that it's important to have a good blend of top-down and bottom-up selection. Top-down in terms of trying to identify which are the sectors, which are the industries which will do well over the medium to long term. If you're able to get that call right, depending on the domestic macro and the global macro, I think that takes care of half the job is done over there. And then look at bottom up based on the criteria which I talked about. I think that has enabled us to really ensure that get more consistency in this fund across business cycles. And also having a proper discipline in terms of trying to manage the risk in the portfolio, because we've seen that during volatile times, how to ensure that the portfolio does well relative to the peers and vis-a-vis the benchmark. So I think managing the risk in the portfolio, both at the stock level and the sector level, has also been a key learning and an attribute which is important to ensure that the fund does consistently well across the various market cycles. So over the last 16 years, I think when initially I started managing the fund and over a period of time, there have been many learnings. But I think the biggest learning I would say for me would be that when you've identified a good stock and a good company and a good management, then ability really to hold on to that and to ride the whole cycle, I think that is something which I have learned over a period of time. In the past, I've identified many good companies, good businesses, but probably sold them off early, okay, just focusing on the valuation. But I think just beyond valuation, there are other things, okay, which one needs to look at in terms of the long-term sustainability of the business, the long-term growth potential, the long-term value which the management can create, which is not seen currently. And once one sees that, then I think it's important to sit on a winners. I think sitting on a winners for the long term, if you're able to do that, because in a portfolio you will have a few stocks, okay, which would be really long-term compounders, and ability to sit on it quietly and let it grow. I think that's where the bigger alpha comes in. So that is, I think, one of the key learnings. And another important learning is that you have to bet on the right management, right? Because we've seen in the past, and more so in the last 5 years, companies where the management quality or the corporate governance issues have come up, markets have severely punished those companies. So really interacting with the management on a continuous basis and having a right framework for evaluating the management so that one can then decide what kind of a premium one is willing to pay over and above the normal valuations. I think that is an art, okay, which I would say I have learned over a period of time, and that can make a big difference in terms of long-term returns for what a stock could generate. The ABSL Frontline Equity Fund is managed fairly tightly and taking measured risk at the stock and the sector level. As a result of that, we've seen that the fund has done both well in the bullish market as well as in market downturns. The observation has been that in a rising market, it tends to do much better in terms of participation. But even in a falling market, the fund has able to weather the fall much better. And overall, I would say that the volatility of the fund is much lower. Again, the fund across market cycles, we've seen the ability to fund to beat the benchmark consistently, okay, over a long period of time has been one of the key highlights of this fund. ABSL Frontline Equity Fund, if one has to really explain in a simple way, is a fund which is a large cap fund investing into the blue chip companies, companies which are bigger and growing bigger, companies which are growing faster than the category average or the industries where they are. I mean, that's what our endeavor is, to invest in these names. The important feature of this fund would be that the discipline which the fund has in terms of what deviation it takes vis-a-vis the benchmark in terms of the sector weights and at the stock level, that ensures that there is fair consistency in this fund performance vis-a-vis the benchmark. And in the last 16 years, 80% of the time the fund would have been in the quartile 1 and quartile 2. Also, this fund is not really biased to any particular style. It has a good blend of value, growth and cyclicals as well as quality stocks. So the whole diversification also ensures that the fund does well across market cycles, and also when any particular style is enforced. And the fund also doesn't have any particular style bias, which is, I think, is a very important feature. It has got a good blend of growth, value, cyclicals and quality stocks. Though I would say that over a longer term, the bias would be to identify good growth companies available at a reasonable valuation, because that's where we think the maximum wealth creation will happen. So the discipline of this fund, the consistency of this fund, I think are the important features which distinguish this fund from some of the other funds in this industry. The fund also has a good blend of top-down and bottom-up stock selection, and the interplay within that helps the fund to ensure that it's able to deliver consistent performance in the medium term and the long term. The fund also does not hesitate to take contra bets in the portfolio, which can add to the overall alpha. So to sum it up, I would say this ABSL Frontline Equity Fund is a fund which has the discipline to ensure that it takes measured risk and delivers outperformance vis-a-vis the benchmark over the longer term. I think that is the important feature of this fund, which would set us apart from some of the other funds. Our advice on asset allocation typically for large cap funds is around 30% of the total overall equity allocation. Within that, ABSL Frontline Equity Fund can be a core part of the large cap allocation, considering its long-term track record. Given that one can have anywhere between 15 to 20% allocation of one's overall equity allocation to ABSL Frontline Equity Fund. Again, from a investment horizon perspective, I would say that the minimum investment should be around 5 years, because that will take care of the whole market cycle, the ups and downs in the market, and should be able to give a reasonably good experience for investors in terms of either beating the benchmark or outperformance from the peers. ABSL Frontline Equity Fund should be a core part of one's portfolio, and it is suitable for, I think, all equity investors, right? But I think it's particularly suited for first-time investors who is looking to invest and capture the whole upside in the equity markets over the longer term. So the first normal investment should be in a large cap fund, and this fund is ideally suited for these investors. Again, since it's a core part of one's portfolio and one should be really looking at to build this fund over a longer term, I would suggest that this is a good fund for SIP investing for investors who want to really start investing into equities for a long period of time. So this is an ideal fund for SIP. The stock selection process in this fund again follows the overall funder's philosophy. Normally we follow the GARP philosophy, which is growth at a reasonable price. When you're looking to invest into a company, we look at 2-3 important parameters. The first one is whether the company has got a very strong competitive advantage, okay, which will give it pricing power and enable it to have a reasonable return on capital employed as the first thing which we look at. The second aspect is whether the company is able to grow at a faster pace than its category average or vis-a-vis the broader industry, because that is what will create long-term value. And the third important aspect is the management quality, because the management quality really decides in terms of the long-term sustainability of the company, and we've seen that good management are companies which are able to make the right capital allocation decision. They're able to navigate the company during the ups and downs in the business cycles. So I think companies which fit this criteria normally, okay, are stocks, okay, which would include in the portfolio. And then finally, valuation, right? Finally, the stock has to be at a reasonable value, and that's what encompasses the overall GARP philosophy for us. The time to sell a stock, I would say, is dependent on a couple of factors. If there is significant change in the underlying business, if the assumptions what we had done at the time of investing have undergone a major change or gone adverse, then is a time when we would look to sell. Or if there are any major corporate governance issues, okay, which crop up, I think that could be a reason for us to sell a stock. And then finally, I think is the valuation, okay, especially in this fund, since we have a discipline in terms of rebalancing the portfolio. So when the valuations become excessive, okay, we normally tend to trim the stock and then look at other opportunities in the marketplace, okay, which are mispriced. The stocks normally which we will avoid are companies, okay, which we think are consistently delivering returns, okay, which are lower than the cost of capital over the market cycle. These kind of companies we don't think will create value over the longer term. So we will normally avoid those stocks. And another criteria for avoiding stocks would be companies where management concerns are there. I think we are very focused on the governance part of the companies. If there are any corporate governance issues or credibility about the management, I think those companies would clearly be avoidable in this fund. We are fairly constructive on the market from a long-term perspective. We think India is very well positioned to grow at much faster than most of the global emerging economies, and that will drive fairly strong corporate earnings growth in the next 2 to 3 years. In the shorter term, though, I would say that the market could be impacted because of global concerns and there could be some volatility, there could be some downside from here. But I think this is a market which should be bought into the dips. Clearly, we are looking at opportunities in the market where are good businesses, because of the global risk of a market correction, are available to at a reasonable valuations. So the endeavor would be to really add good businesses in this market correction, okay, when they present to us at a more reasonable and attractive valuations. In the recent years, we have seen the rise of some of the passive funds, and when positioned against the actively managed fund, I think the key criteria is the ability of the fund to beat the benchmark, okay, over a market cycle. Our endeavor would be to take calculated bets in the portfolio and ensure that we beat the benchmark consistently over longer term. Though I would say that the alpha which the fund has done in the last 16 years vis-a-vis the benchmark, that would come down, okay, in the current context when we have seen the ability of actively managed funds, okay, to beat the benchmark is kind of challenging. But with our processes and an ability to really do stock selection and manage the risk, we are looking to ensure that this fund beats the benchmark by a reasonable margin. And if we're able to do that, then I think this fund can be looked at as one of the core portfolios. And vis-a-vis passive funds, it would really stand out because of its ability to generate alpha over the market cycle. Going forward, we are more positive on India growth coming back rather than the global growth. So our positioning as a fund house is more towards domestic stories. Last year, it was more the global cyclicals, okay, which we played out either through the IT sector or the commodity sectors. But I think going forward, we believe that India growth, which is still to really reach to its pre-COVID level, will continue to improve going forward. And the India's macro situation is a much better place. So given that we are positive on the banking and financial services sector, we think this sector is likely to see better credit growth improving going forward. The credit costs are likely to remain low, and we see margin expansion on the rise as interest rates and repo rate increase happens in the next few quarters. So clearly, we are in the fund also overweight on the banking and the financial services sector. The second important theme as a fund house which we are betting on is the domestic consumption, the discretionary consumption. I think India is at an inflection point where the per capita incomes are increasing, and discretionary consumption as a percentage of total consumption is also likely to move from around 25% to around 40%. And that's a long-term secular theme which we see doing well, and identify good companies, strong brands, okay, which will continue to grow and increase market share in this space, I think will create value. So we are overweight on the consumer discretionary sector. Apart from that, real estate sector is also something which we have seen a revival after 5 years of downturn, and there are enablers in place, and that's a sector which should do reasonably well. So we are also overweight on that sector. Besides the other important theme which we think India is likely to do well is the whole capex story. The private sector capex is likely to improve going forward. We are seeing some initial green shoots, but I think as the growth comes back, the whole industrial and capital goods sector is likely to benefit not only from the substitution of imports, but also the government impetus on the whole production like incentive schemes and domestic manufacturing. So that's another sector which we think will do well over the medium term. So over a period of time, we have aligned the portfolio in terms of overweights in these sectors. The fund is underweight currently in the oil and gas sector, okay, where while there is value over there, but we are seeing many policy flip-flops over there, and structurally we don't see this sector really creating big value. So that is one of our large underweights. Overall, as a part of the consumer discretionary space, we like the auto sector, and the fund has increased its weight in the auto sector because it is coming after 3 years of downturn, and with commodity prices easing, we see margin pressure which was there is likely to ease off. Besides that, telecom is another sector where the fund is overweight. I think in this sector we look at it as a more defensive and a steady growth, because the sector has seen a consolidation, and with price increases going forward, we see steady earnings growth in the telecom sector. The sectors which we are underweight are essentially large underweight is in the oil and gas sector, primarily from the reason that we don't see much of a growth in this sector, and because of the global slowdown and the policy flip-flops, we don't see any significant wealth creation in the oil and gas sector. A second overweight, large overweight, would be in the consumer staple sector, which is a good sector, but I think the valuations in this sector are again demanding, and while we like this sector from a long-term perspective, but looking at the valuations, we are underweight in the consumer staples at this point in time. The corporate earnings growth, starting for this fiscal year, we've seen the first quarter numbers have been fairly in line. There was a concern getting into this first quarter that one would see large downgrades, considering the fact that we have seen some amount of slowdown globally. We've seen material prices rise in the last quarter, but by and large, I think the numbers have been fairly in line. We're not seeing any major downgrades. Sectors like banking has done well. Auto sector has also surprised. IT sector has seen some kind of marginal downgrades because of margin pressures. But overall, I think we're still looking at around 15-16% earnings growth for the Nifty 50 earnings in this fiscal year. And I think going forward, I think as the monsoons pick up, one should see the rural consumption also doing well. And I think one would expect that the earnings growth in the next 2 to 3 years, at least for Indian companies, should be in the low teens, which is, I think, a fairly good outcome considering the fact that globally, okay, we could see downgrades to earnings at a time when we are being faced with concerns about global recession looming around. My asset allocation advice to investors at this point in time would be that stick to your target allocation, which one advisor would have suggested you based on your risk profile. This is a time not to deviate too much from that target allocation, because the risk reward across asset class is fairly well balanced. Equities, I think, will give you returns in line with its long-term average from here, considering the fact that they are in the fair zone. Debt as an asset class which was ignored over the last couple of years again looks interesting at this point in time, as we are seeing interest rates slowly inch up. So that should also be considered, okay, when one is making the asset allocation. And we are in store for volatile times. You will see markets moving up and down. So one should actually treat volatility as one's friend, and whenever one sees large correction in the market, one can then use that opportunity to increase equity allocation in one's portfolio. Otherwise, I would say that stick to the discipline and maintain your target allocation. I think that should do well in terms of managing returns as well as volatility. If I have to sum up my investment journey in managing the ABSL Frontline equity fund in the last 16 years, and the learnings from that would be: markets are going to be volatile. Treat market volatility as your friend, because during volatile times is where the biggest opportunity is available in terms of picking stocks which can make a big difference to the portfolio going forward. Second, management, focusing on the right management and betting on the right management. If you do that, then half the job is done, because then the management is working for you. Maintain the right diversification, appropriate diversification in the fund, because that enables you to manage large size. And finally, holding on to your winners and sticking to them by conviction is one of the key success factors in terms of fund performance.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.